Hi, my name is Kevin Feig, and I'm the founder of Walk You to Wealth. I want to spend just a few minutes talking about 3 common mistakes that I see with investors today. 1, lack of diversification. So I review a number of portfolios as part of my business, and I would say lack of diversification is certainly something that stands out. And when I talk about lack of diversification, I'll just use it from a stock market perspective. All of us have what we call hometown bias, meaning we invest in our home markets and primarily invest in our home markets. The way this plays out, statistically speaking, is about 80% of someone's equity portfolio in the United States is in US stocks. Now, if you looked at the market cap being just the size of the US market versus the rest of the world, right now it's closer to about 60-40. Historically, it runs about 50-50. Just use the 50-50 for sake of this video. So if you think about it, 80% in US markets in terms of our equity positions, at least from various reports. And historically speaking, it's closer to 50-50, meaning 50% of the value of publicly traded companies is outside the United States. So again, hometown bias is significant. This has only become more and more of an issue over the last decade as the US has continued to outperform pretty significantly international markets. So it feeds into also our recency bias, meaning our recent investment was so good, we'll just keep rolling it forward. And then that margin, if you will, that 80% just becomes larger and larger, meaning we become more concentrated in US stocks and less diversified. So lack of diversification, stocks being just one example, but lack of diversification is something that I see a fair amount. Next item on the list, social media. Huge mistake that I see individual investors make is reacting, and I shouldn't even say just social media, also traditional media, but reacting to media. So using your emotions and playing on the algorithms. So let's use fear of a recession. You have fear of a recession, you watch a YouTube video or an X video or an Instagram video, whatever it may be. You watch something about a recession and now your feed is just filled with recession information, right? Everyone seemingly in your social media feed is predicting a recession. Well, what that makes you do is it helps you panic, right? You panic because everything you're seeing is there's a recession coming, there's a recession coming. Now, that's not everything that's out there, right? But that's the algorithm. The algorithm is designed to show you what you want to see. And because you want to see and learn about a recession, that's what you're seeing. And so reacting to that is one of the biggest challenges that I see for retail investors. The third one is ignoring fees and taxes. So when we talk about fees, this may be investment related fees, so underlying mutual funds and ETFs and the cost of those. And that's sometimes difficult to delineate, right? Because they're not charged in dollars, they're charged in percentage or expense ratios. But ignoring those fees is certainly critical, and ignoring taxes. So when I look at a portfolio, I always think about a couple different things, but 2 of them are, do we have the right assets for the client? But the other one is, do we have the right assets in the right places? So from a tax perspective, we want to be cautious on where we're investing in certain assets, also known as sort of asset location. So asset selection, hugely important. Asset location, especially from a tax perspective, is also really important. Those are the big 3 items that I see: lack of diversification, especially in the stock market around US and international stocks, listening to social media, and ignoring fees and taxes. How do you counter these? I'd say 3 things. 1, have a written financial plan. If you have a written financial plan, you're just less likely to be reactive. Work with a financial advisor. And it's not because I am a financial advisor, I just think there's value in having an independent opinion, especially if you have the right relationship and the right person. And lastly, put on your financial blinders, right? If you ever watch the Kentucky Derby or a horse race, or you see a horse-drawn carriage, horses wear blinders, right? So they don't get distracted by what's around them. So you need to put on your financial blinders so you don't get distracted about all of the recession items in your algorithm. Hope that was helpful. Looking forward to seeing you soon.
The information in this video is provided for your convenience only and is not intended to be treated as financial, investment, tax, or other advice. The information is intended to be educational and is not tailored to the investment needs of any specific individual. It is also not intended to be relied upon as a forecast and is not an offer or solicitation to buy or sell any securities or to adopt any investment strategy. The opinions expressed are those of the author. Reliance upon the guidance and information in this presentation is at the sole discretion of the individual.